provide in a system.
Sorry.
Okay. And also, then, as it is said on the page, it includes of course, the main important statements that are a balance sheet that we get at the end of each quarter, then income statements and cash flow statements. Yeah, the first one, sister. The page before.
Okay.
Because this doesn't have the number. Yeah, this is the one. Okay. Another importance is to provide in a systematic manner financial information to help manage and control the organizations. This is page 3. Okay, so yeah, you may move forward. Yes, now. Oh yeah. Yes. Then another importance as means of showing accountability and transparency to partners and stakeholders, example, shareholders, donors, and family members. So, of course, all that we are going to do, all the registration, all the accountings, is also help so that we are able to report, to give clear information to those or help financing our projects or businesses, whatever we have in mind to do. On the page 5, because also is to provide verifiable financial information necessary to filing VAT and income tax returns, so that this the bookkeeping also helps to see how, when we have something to sell or when we are buying, to see how taxes are implied in the income or expenses that we make. Yes, so that keeping a record so that financial information easily accessible also when needed. On the page 6, now we're going to now we're going to understand maybe in a bit depth what is bookkeeping. So it is the process of recording and keeping track of all an organization's financial transactions, and it is usually done on the double entry system of accounting. Maybe also to understand what is bookkeeping, is accounting, is the processor keeping or the accounting books of the financial transactions of the company. And we have some types of bookings that are some we use on daily basis, maybe others at other times, and maybe some just once a month. So we have cash bookkeeping, then accounts receivable when customers owe money to the entity, or we have sold something but not received. Then is inventory, accounts payable, loans payable, sales, purchases, and payroll expenses. So these are some of the books that after we are going to understand their meaning also later. Then still on the page 6, that's also the double entry that is important to understand. Every entry to an account requires a corresponding and opposite entry to a different account. Double entry has two equal and the corresponding sides, known as a debit and a credit. A transaction in double entry bookkeeping always affects at least two accounts, always includes at least one debit and one credit, and always has total debits and total credits that are equal. So, for example, when you go to the bank and you withdraw, for example, 1,000 rands, so we have to show that this money came from the bank, So it is a debt to the bank and is a credit into your cash, your book, so that what enters is also has to be equal to what goes out. So it is what means double entry. Now, what is accounting? Accounting is the process of classifying, preparing, and analyzing financial data based on the transactions recorded through the bookkeeping process. So it is that every income has to be classified and then registered properly into the books. So not to do one thing and to say a different one. On page 8, we are going to see also what is the role of the accountant. An accountant prepares 3 key financial statements, which are the balance sheet, income statements, and cash flow statements. So maybe also to understand what is the balance sheet, maybe some of us are not maybe acquainted or aware of it, is a statement of assets that comprises of liabilities and capital of business or other organization at a particular point in time. Also detailing the balance of income and expenditure over the deciding period. So this is a recording. I mean, that brings together all the movements of the other reports in a kind of a summarizing way and explaining well where the money came in, went out, what are the assets. And it also comprises of current cash assets, current bank assets, medium and long-term credits, investments, and fixed assets. Still on the same page, income statements, it shows a company's revenues, expenses, and profitability over a period of time. It is also called the profit and loss statement. After later, I think I'm going to look at these statements. And then also we have the cash flow statements. It is a financial statement that provides aggregate data regarding all cash inflows that the company receives from its ongoing operations and external investment sources. It's also called cash flows. It also includes all cash flows that pay for business activities and investments during a given period. Then on page 9, we have that, so now introduction still, books of accounts refer to the records kept of an organization's financial transactions. A financial transaction is an exchange that results in inflow or outflow of funds from an organization. So here we have the books of accounts that include documents and books used in the preparation of final statements that we mentioned before, that are the balance sheet and the income statement, cash flows. And it comes from the journals, ledger, cash book, bills, receipts, and daily cash registers. On page 10, so every financial transaction that takes place involves money that is earned, spent, infused into or drawn out of the business. A financial transaction will thus result in an increase or decrease in incomes, expenses, assets, liabilities, and owner's equity. So infused money, maybe I think the other ones you understand. Maybe, so infused money means that the act of providing more money or resources to make something stronger or work better. Then on page 11, we have the sources, documents for the accounts. So books of accounts are prepared from what is referred to as a source documents. Source documents are both internal and external documents raised whenever a transaction takes place. So book of accounts are prepared from receipts, bills, invoices, statements, anything that documents a transaction. So the why it is I always insist that that is always important. So then when we buy something, it's always good to have a receipt or something that proves that we have paid. So also it helps the recording. Also when we sell, so to that we are also keeping it to prove that we sold and it is recorded in the proper manner. On page 12, then some source of documents, the common source documents, sometimes called accountable documents, used to record transaction in the books are supplier's invoice, sales invoice, receipts, both internal and external. So I was maybe going to explain a bit to understand what are supplier's invoices, what are sales invoice and receipts. So supplier's invoice are bills issued by a seller to a buyer. The seller, also known as a supplier or vendor, can invoice the buyer, who can be first-time customers or recurring clients for goods or service. Sales invoice, it is a document sent to your customer or purchaser that names them, the goods or services you have provided to them, and when those items were delivered. A sales invoice might also include an itemized portion of the final fee, noting the sales tax, shipping fee, or any other external costs. Receipts, it is a written acknowledgement by a receiver of money, goods, or that payments or delivery has been made, the act of receiving or fact of being received. Then on the continues on the page 13, cash sales and cash sales, petty cash vouchers, delivery notes, goods received notes, credit notes. Now the check payments vouchers, I think they are no longer in use in South Africa since checks have been abolished. And then check counterfoil. So cash sales is a transaction that records the sale of goods or services for which you receive immediate payment. Petty cash vouchers is a form or document that reflects the amount and the reason for pay cash disbursement. Delivery notes is a document that accompanies a shipment of goods. It provides a list of the products and the quantity of the goods included in delivery. Goods received notes, it is a record of goods received from suppliers, and the record is shown as a proof that all the products have been received. It is also a record used by the buyer for comparing the number of goods ordered and the ones delivered. Credit notes, it is a document issued by a seller to a buyer to notify the credit that credit is being applied to their account. And check counterfoils, it is the part of a check ticket or other document that you keep when you give the other part to someone else. Then on the page 14, we have the main prime used to record financial transactions, the main prime books, which are the cash books, which is a financial journal that contains all cash receipts and disbursements, including bank deposits and withdrawals. A petty cash book is used for recording payment or petty expenses, which are of smaller denomination, like postage, stationery, conveyance, and refreshments. On page 15, we have a sales day book, a purchases day book, a journal book, and fixed assets register. Sales day book, a record kept by a business of the money it receives from goods it sells each day. Purchases day book is used to record all the purchase invoices for goods and services supplied on credit to the firm. Goods are received immediately, but payments is made at the later date. Journal books is a book of transactions recorded in a chronological order. Usually, transactions are recorded in a journal before they are recorded in a ledger account. And the fixed assets register is a detailed list of all fixed assets which are owned by a business. Its main purpose is to enable an organization to accurately record and maintain both financial and non-financial information pertaining to each asset and to easily identify an asset when required. Page 16, then we have the general ledger. It is a set of numbered accounts a business uses to keep track of its financial transaction and to prepare financial reports. Each account is a unique record summarizing a specific type of asset, liability, equity, revenue, or expenses. I think in the past there was that big. I think some are using a big book that we put each voice on top, and then the amounts follow on the way down. Then the sales ledger is an account for every customer of a business and records the money received for products or services plus what is still owed. Then purchases ledger, it is an account of the suppliers of a business documenting from whom the organization has made purchases, what's been paid for, and how much is still owing. The inventory stock ledger is a document or computer record that tracks inventory transactions. But one is also this aspect, and one is, I think also I'm going to see forward, it is also to see what you have in stock, but I think we'll come to that. Then on page 17, so book of accounts may be kept either in manual form or in a computerized system. Many times we are advised even to keep the both of them, also for safety, because if you keep everything in the computer, maybe for example now load shedding, so you maybe work then you lose, or in case of theft or any hazard that may take place. So it's always good to have in the written and in the computer. Then on the 18th page, the main cash books. These books record receipts and payments through the bank. So then all transactions that you make in the bank are registered in this book. And it shows amounts received or paid through the bank at the person from whom received or to whom paid. It is usually analyzed into the various accounts involved. Then there are account titles that are salaries, telephone, repairs, and so on. Then on the following page, we have the receipts still on the cash. That receipts are shown on the left side of the book, and the payments are shown on the right-hand side of the book. Sometimes also the book is split in two, or one for receipts and the other for payments. Then on the page 20, the Also, main cash books are where an organization sells products, services in cash. This can first be summarized in cash sales books and the daily total transfer to the main cash book and bank intact. So there are different systems in which to use the main cash books. On page 21, now we go to understand what is a petty cash book. So it records payments done in cash only, usually in small amounts. It shows amounts paid and the person to whom paid. It is usually analyzed into the various accounts involved. So first, whatever small expenses you register in this petty cash book, and then only at the end, maybe you can summarize, and then you paste or place in all the respective account books involved. On page 22, the petty cash book is operated on an impressed reimbursement system. All cash payments must be supported with external evidence, receipts, cash sales. The source document is cash payment voucher. So once again, then also the petty cashier is reimbursed, refunded by the accountant. Cash drawn from bank on the basis of what he or she has spent in order to maintain the petty cash float. So then once again, always reminding ourselves the importance of keeping receipts and cash sales as supporters of incomes and the expenses. On page 23, sales day book. The sales day book summarizes the daily credit sales of goods and services. It records the sales invoice number, amount, the customer or client. The daily total is posted on to the sales account control account. So the sales control account is used to control the accuracy of the financial documents. On page 24, then purchase day book. The purchase day book summarizes the daily credit purchases of goods and services. It records the purchase invoice number, and the amount, the supplier vendor. The daily total is posted to the purchase control account. So it is also good that always on the invoice or the number be kept in order, and the amount. Then we have the fixed assets register. Fixed assets are also known as non-current assets, comprising of land, building, plant, equipment, vehicles, furniture, which are used over a long period of time. And fixed assets produce income or facilitate the generation of income. On page 26, fixed assets are also recorded in the fixed asset register, which shows depreciation of asset, date of purchase, where located, serial number of manufacturer's number, purchase cost, accumulated depreciation. Maybe I think maybe when you come to another part of I think one of the further workshops, we will see also how to analyze the depreciation. What is the formula? For example, when you buy a car, of course, as the years go along, the value than the cost at the beginning, or its value. But then also how much money you are supposed to put aside according to the depreciation, so that you know how much money you need, for example, in case you need to buy a new car. So, but then we shall come later during our sessions to understand these formulas. On the page 27, the fixed assets register, depreciation is defined as a loss in value of a fixed asset due to use, tear, and wear or passage of time. Depreciation is calculated either on straight line method or reducing balance methods. Landing is not usually depreciated unless it is leasehold land. Yeah. Yes. So just now some of the descriptions. Now, another important is in our account is the general ledger. This is a book containing a page or pages of every account in an organization. After recording transactions in the journal, the components are debited or credited to accounts maintained in general ledger. So then, it would be good to show, but for example, in this ledger, then it includes all the assets, liabilities, equity, expenses, and income or revenue. On page 29, then we have the general ledger. The format of an account is the general ledger is either a T or a horizontal format. The T account has a debit and credit side. Debits are shown on the left hand side, while credits are shown on the right hand side. So T account is, just to remind, maybe for us, T account is an informal term for a set of financial records that use double entry in bookkeeping. It is called T because the bookkeeping entries are laid out in a way that resembles the T shape. So the account title appears just above the T. As we said, so so the T on the right hand side are the debts, and on the left hand side the debts, and on the right hand the credits. Then the posting to the ledger is the process of transferring the information in the journal to the individual accounts in the general ledger. At any point in time, the balance of account can be determined. I think you have done some examples, yeah, of how to deal with it, how to use these T accounts. Then on page 31, we have the sales or debtors ledger. The sales or debtors ledger is a subsidiary ledger which contains the individual accounts of customers, clients. At any point in time, the balance on a client account can be determined. So the sales ledger is your record of sales and whether or not you have received the money and how much you are still owed. On the balance sheet, the total amount you owed to you by customers will usually be called trade debtors or accounts receivable. On page 32, still under the sales debtors, at monthly intervals, an age listing analysis of debtors is prepared or extracted from the sales ledger to facilitate follow-up the collection of overdue accounts. So it helps to see who is in debt, how much, and maybe to also to agree the times that the customer needs to pay or to pay back his debts. Then the purchase creditors ledger is a subsidiary ledger which contains the individual accounts of suppliers, vendors. At any point in time, the balance of suppliers' accounts can be determined. So now is on the other way around. The purchase or creditors ledger aims to provide knowledge about which suppliers your business owes money to and how much. So also to know when you have to meet the payments, and also to and agree the timing of paying them. Then page 34, purchases credits ledger or ledger. At monthly intervals, an age listing analysis of creditors is prepared from or extracted from the purchase ledger to facilitate reconciliation and payments of suppliers' accounts. Yeah, so a bit what we said already in the page before. Then we come to the inventory. So the inventory or stock ledger is a subsidiary ledger containing details of items of stock held for sale or resale. Inventory stocks are the products an organization trades in to earn or a profit. Page 36 so continues. And then the inventory stocks ledger will record the receipts and issues out of goods from the stores. The documents used to update the stock ledger are the purchases and sales invoices, credit notes, goods received notes. Of course, this is one is to help to see how much when to sell, when to buy, but also the inventory is there's also a type of inventory that is used, for example, for you to see what, for example, if we have a workshop, if you have material, to see how much you have in stock, how much, then to see how much you need to buy to replace to keep all the amount. Yeah, so to also it helps to the running to see what to keep, when to invest, where to buy. Maybe that was the best time to do it. Then eventually each item of stock will show the opening balance, sales and purchases, both in value and quantity, as well as the average unit cost and the total value. I think in the next page we will see a bit. So we'll see an example how it is done. So then, for example, when you have a item, you have an opening balance, how many items you have, then the value. If you have received, you also receive the quantity. You put you register the value of the items received. If you issue out, when you went out, also the amount received, and then you have the closing balance. Now on the trial balance is extracted, prepared from accounts with balances in general ledger. Debits and credits must always agree. So if they don't agree, it means that there's a mistake somewhere. Maybe something was not registered well. So then we have to go back and to find out where it happened. So that's why it's always important to keep the receipts or all documentation well placed, well kept, and so that we have to go back, we track well, and solve the problem. Trial balance is the report of accounting in which ending balances of the general ledger of the company are available. The main purpose of trial balance is to ensure that the list of credits and debits entries in the general ledger are mathematically correct. And then on page 40, the trial balance is simply an arithmetic check on the accounts maintained using the double entry method of accounting. At the end of an accounting period, usually monthly, all the accounts having a balance in general ledger are listed on a summary sheet to form a trial balance. So then in conclusion, we list here below the common accounting documents, sources, documents used to record transactions in the book of accounts. So we have seen are the suppliers' invoices, sales invoices, the receipts, both internal and external. Then we have also on the next page, we have the cash sales, petty cash vouchers, delivery notes, goods received notes, credit notes, of course you don't check payment vouchers. And that's it.
Can I show the sample, no? The one you sent?
Yes.
We see it now?
Yes, I see it. Yeah. Okay, so this is what we call, for example, there are this you can have, for example, this is a 3-month report of profit and loss of a school or a pastoral center like Maria Todos in this case. So this can be done monthly or quarterly according to the requirement of the institution or the diocese to whom you need to report. So we have the income, so this shows what enters into the institution and the basic main expenses. So this is one of the reports. This, I think, this is extracted from the QuickBook accounts, which is I think the simplest one. Maybe next. Maybe you can the next page, next sample. And this is the balance. Yes, this is the balance sheet, which is extracted from the cash flows or the profit and loss statements, which shows you now, for example, what you have in as assets, current or fixed assets, what you have in the bank, and what you have in cash, and even on petty cash. So all your assets, either current, fixed, or even liabilities, are properly recorded and summarized in this page, this sheet. Then, of course, this is the April. This is the 3-month report, so that now all the information is recorded from the period of 3 months. So again, it shows what was the income and its total, then what are the expenses, the total, and then it gives you also the balance, which it shows if you have a profit or a loss at the end of each period of time. So then, for example, this when you have this exercise, this final exercise, then for example, if you need to work out on a budget, so you can always fix. I mean, based on this extract of this annual report, and base what you have to plan for the future. But also it helps to see if you are positive. Okay, it means that the center or the activity is in a good health. But if it appears negative, so you have to see how to recover the money, where to get the sources, so that you are not running at a loss, but having means to go on and invest, or at least, or not just surviving, but to have a good running of the institution. Yeah. So, for example, in this case, in that time, so of course this can, of course, at the end of the year may not be easy, because this is just part of the year. But you see already that there was a loss of between the income and the expense was a loss of 48,000 rands. So then, of course, then if you go on to see how we are going to, then that's what we call the for example, sometimes you have to ask for loans maybe to the bank in order to to keep it going, but we cannot last forever. Yeah? So we have so we have always to be attentive when we are having too many expenses more than incomes, and we have to see how to bring it the other way around.
We're not sure if you have any comments or questions, but I'll just quickly also show the example of the books. The first, I think on top, it's a ledger book. Is sometimes it could be thick, could be thin, but you can find it at CNA, PNA, or some of the stationery shop. And this is a cash book. One brother mentioned that it's one side is the receipts, one side is a payment, and the debit and the credit. The debit's always on the left, and the credit's always on the right. And then this is also the ledger. It's a manual ledger that written by hand. So it's basically you can have different forms of or different styles of the books, but yeah, whatever methods you use, it's just for your own convenience as well, and your own understanding, and easy to follow. Is there any questions so far? Are we familiar with the trial balance as well? Sister Miriam, do you have any questions?
All fine, thank you, sister.
Okay. So I think the material is quite clear for everyone. Just to let you know that next week, also on Tuesday, we will do the accrual and cash basis of accounting. We will do more on cash recording into the books, or how to record or post into different books in our accounts. So is it still okay with anyone we have on Tuesday at 2 o'clock, right? We hope the time is okay for you all. So I hope that the material is helpful for all of you. Yes, we will send out this document to you, so you can also take a look again. And then if you have any questions, you can always send us an email to lcclsa@nlab.co.za, and we'll help you with whatever your query or your questions. Brother Paulo, do you have any other comments?
No, not for now.
Okay. So thank you very much, everyone, for joining us today. And we also wish and hope that you will have a very fruitful Holy Week and the Easter Triduum. And we wish also Happy Easter to all of you. Hope you will have a very fruitful and grace-filled time with the communities and with families if you happen to be with your families.
Yes.
Thank you, Sister Tara.
Thanks
And
so
thank
much.
you, Father.
Happy Easter to you too. Thank you.
Thank
Happy Easter to you, all of you too.
Thank you.
God
and
bless you all.
Thank
Bless you.
you.
Bye-bye.
Bye
Bye.
bye. Thank you.
Bye.
Bye bye.
God bless.
Bye-bye.
Bye.